Hello traders, you're welcome back to the Forex Geek channel. In this video, we are just going to be looking at an incredibly effective strategy, and that is the EMA and MACD strategy. So if you are looking to catch strong trends while avoiding false signals, this method will help you improve your trade accuracy and confidence. Let us just break it down step by step. Okay, the exponential moving average The exponential moving average is one of the most powerful tools in a trader's arsenal. Unlike the simple moving average, the EMA gives more weight to recent price movements, making it react faster to market changes. So this makes it ideal for spotting trends early. All right, that is for the exponential moving average. Okay, then the MACD, on the other hand, the moving average convergence divergence indicator helps us measure momentum. It helps us measure momentum. It consists of the MACD line, the signal line, and a histogram that visually shows momentum strength. When combined with the EMA, when you combine the MACD with the EMA helps confirm whether a trend is truly strong or if it is about to reverse. So why is this combo so effective? The EMA tells us the overall market direction, while the MACD gives us high probability entry points. This eliminates a lot of noise in the market and keeps us focused on strong setups. Now let us just get into the exact steps to trade this strategy effectively. First of all, you have to choose your EMAs. All right, we're going to be using the 50 EMA and 200 EMA. Okay, we're going to be using the 50 EMA and 200 EMA. All right, 50 EMA, 200 EMA. Okay, let's increase the thickness of this. All right, so we've added the 50 and 200 EMAs to the chart. The 50 EMA is used for short-term trends, while the 200 EMA helps us identify the overall market direction. If the 50 EMA is above the 200, like what we can see happening here, the 50 EMA is above the 200 EMA, we focus on buying opportunities. If the 50 EMA is below the 200 EMA, we focus on selling opportunities. Then you use the MACD for confirmation. The MACD indicator will confirm our trade direction. We wait for a MACD crossover. When the MACD line crosses above the signal line, the MACD line is the blue line, right? When it crosses above the signal line, which is the red line, it's a buy. All right, so that confirmed this buy signal that the MAs gave us. Then on the other hand, when the MACD line crosses below the signal line, that is a sell confirmation. Okay, in addition to that, you should wait for price to retest the EMA. Okay, we do not just enter at random. Instead, we wait for price to pull back to the 50 EMA. For example, you can see that after this breakout happened, the switch from the upside to the downside, you can see that there was a retest. Price went up to test the EMAs first before coming down back. All right, so it's important to wait for those retests. Okay, the next thing now is to place your stop loss after you've confirmed your entry. Let's start with the buy. After you've confirmed your entry, for example, the bullish crossovers with the MAs, the bullish crossovers with the MACD, and the bullish histogram bars, enter your buy trade, set your stop loss below the previous swing low, and your take profit can be around resistance zones. Okay, you can aim for a risk to reward ratio of 1:2 minimum. All right, then in the case of a sell, of course, the reverse is the case. Now, not every setup will be perfect, so it's important to confirm with other factors like support and resistance, and that is the reason why support and resistance are one of the references we use for setting take profits. Okay, this increases the probability of a winning trade. All right. Okay, let's just look at a sell example before we round up. So in this case, we can see that the 50 EMA crossed below the 200 EMA, and then you can see that the MACD crossover happened around here. So do not just jump into the trade after the EMA's crossover. Wait for the MACD crossovers as well. The MACD crossover happened around here, and then we can see that there was actually a rejection from this resistance. Guess you can see carefully that there is actually a resistance zone around here. So price got rejected around the resistance, and we had the formation of a bearish candlestick pattern. Remember, that candlestick pattern is one of the things you should you should be looking out for. We can see that we had the formation of these three black clouds formation around here, and we had a retest of the 50 EMA again. So after that, this would have been a great opportunity to enter a sell. Stop loss above the swing high. Take profit can be around key support zones. All right, you can use key support zones for your take profit. All right, now before using this strategy in a live market, it is crucial to backtest it on historical data. Okay, you can do this by scrolling back on your charts. You can literally scroll back on your chart, and see how the setup would have performed. You can just go to historical price activity and just analyze the market based on this strategy. Look at how price performed, how price reacted based on this strategy, and gauge the profitability. All right, you see how the setup would have performed. Also, you start with a demo account to refine your execution before trading with real capital. All right, and remember that risk management is paramount. Do not trade with an amount that you cannot afford to lose, and make sure that you do not neglect proper risk to reward ratios. Okay, it's important to have good risk to reward ratios, and also you make sure that you do not over leverage. All right, it's recommended not to risk more than 2% of your account balance in a single trade. All right, capital preservation is very, very important. If you make profits and at the end of the day you lose your capital and everything, it's not worth it, right? So you should make sure that you preserve your capital at all costs. Okay, of course, while you are trading, you want to make profits, right? But risk management demands that you preserve your capital. So if you are risking 50% of your account in a single trade, it's very bad. If you're risking 30%, it's very bad. In fact, 10% is not good. All right, if you want a conservative approach, unless if you're a very aggressive trader, well, but for the sake of risk management, for the sake of long-term success, it's better to use small percent of your account at a time. And that is how you can trade using the EMA and MACD strategy. If you found this breakdown helpful, be sure to hit that like button and subscribe for more trading tips and strategies. Also, let me know in the comments what is your favorite trading strategy. See you in the next video.